What's up, everybody? I'm Matt, and today I'm making a video to show you guys how I pick my stocks. I'm trying to simplify my videos. Simple as easy, like you could pick your nose or you could pick your friends. Hopefully I can simplify stock picking so none of those are even a worry. I want to make it so easy for you. So how do I pick my stocks? Let's say you follow me on Twitter or Instagram or one of the other platforms where you see my posts. Then you know I love math. I love math. I see demand, I see patterns, and I generally see them first. I analyze volume, and I know when there's about to be a spike, so it gets me excited. So if I'm a little excited here, that's why. But I look at it and I use my phone. So you guys are like, oh, he's probably got like 4 computers laid out. Guy's like hitting away on his keyboard. He's like, oh, beep, beep, beep. Oh, it's an alert, it's an alert. That's not how I do it. I dumb it down. I dumb it down because I'm trying to simplify things. I'm trying to make it so you guys can see exactly what I'm seeing. So I'll look at a 1-month chart and my bars on the bottom are either yellow or green. A lot of you have red and green. That doesn't matter. I mean, Christmas tree, other ornaments, doesn't even matter. But what do I see? So the size of the bar has to do with volume. So if you see a large bar and then little, there was massive volume that first day and then volume's deteriorating. I don't like those stocks. What happens? You see a huge spike, huge volume, you get involved, it goes down 10%, you're like, oh, it's gonna turn around, it's gonna hit that point again, you know, I'm gonna make some money, I'm smarter than everybody else, and I'm not saying you're not, but I'm trying to simplify it and show you exactly what I'm seeing. So I look at the bars, and I'll use the 1-month chart, and we'll use like Webull for an example. You look at the 1-month chart, and at the bottom of the screen, you'll see red or green bars. And as the bars grow in size, that's your volume, that's your demand. So red would be outflows greater than inflow, meaning more people want to sell than want to buy the stock. That's not good for demand. That usually means the stock's going down or it might fall below support. Who knows where the support level is? We can talk about support level at a later date or later in this video. But let's just talk about volume and demand and what I see to pick my stocks. So I generally look for certain types of stocks before I look for volume or demand. I look for distressed stocks, stocks that have been beaten up for no reason. Maybe they missed earnings or something to that extent, or you know, what have you. There can be a lot of reasons that stocks are distressed. You know, sometimes the hedge funds or these ETF or these large accounts, they have to sell a certain position. It's the end of a quarter and they don't want it to look like they have this stock on their books. So they'll sell. And unfortunately that forces the stock down. But you could see that. You could see the red bar. You could see the outflow is greater than the inflow. So what am I talking about? I'm just here to simplify. You want to look at that. You want to see exactly what I'm seeing. If you see spikes and there's just green day after day after maybe a turbulent 2 weeks, that's a rebound stock. It's finding its bottom. I'm not saying it's going to go up, but when you use that information and you use my 25% rule or my 10% rule, you can enter the position the right way. So we're looking for the stock to bottom out. Very easy. You see a stock, it's bottoming out. You don't have to guess the bottom. When it's on its way down, the boat's going down, you don't have to say $15 is good. Why? Why is $15 good? You just made up a number. There's no strategy involved. So take your time, wait for a stock to bottom. When you start to see a stock turn the corner and there's demand and you see green day after green day, and if there's a spike like heavy volume, that just tells you an institution or somebody got involved. So again, here are things that I look for. I'm going to simplify it. I used to work for hedge funds, a couple of these institutions back in the day, okay? There were certain times of the day that we would purchase a stock. We would let all the craziness die down in the market from 9:30 to 10:30 a.m. Then at 10:30 to 10:40, we would make a small buy, try and fit in so no one saw that we were interested in whatever stock it was. Then we'd make another buy, maybe at like 11 o'clock or something like that. Then you'd have the lunch hour, so hopefully the market would die down a little. I mean, new followers, new traders, old traders. We all see that happening now. There's like a lunchtime lull, I'll call it. So what do? So you're an institution, you want to get the best price, just like investors like you and I want to get the best price. So what do? They wait for the stock to go down a little, and then they'll purchase around like 2 o'clock, 2:30. These are all Eastern Standard Times. I'm an East Coast kind of guy, okay? And then they'll do one more purchase before the end of the business day, whether it's 3:30 or 3:50. So they were able to buy 4 probably substantial and large positions. Now, depending on the institution or the hedge fund that's buying this buying could go down for 2 days. It could go on for 3 days. I mean, you have Kathy Wood at ARK. She's got so much money, and when she buys a stock, not only is she making it transparent, which I love that she shows you guys what she's buying. I live by transparency. It's easy. You don't have to make up stories. I tell you guys what I'm seeing. I tell you guys what I'm doing, and that simplifies it. Okay, but she's transparent, which is great, but she might take 2 or 3 days to fill the number of orders and the amount of stock she needs to buy. So if you see it or you get the alert, you know, I offer these alerts on my platform, 349 Trading, but that's not why I'm here. I'm telling you guys how I pick a stock. So again, if you have this alert, if you just see the spike in the volume, very simple, okay? Then you know to buy. So there were stocks I saw today, they were spiking 4%. Well, that's not a spike. It is when you see the increase in volume along with the increase in price, all right? Supply and demand. Increased volume, increased demand, higher price, okay? So that's what we're looking for. Then people will sell off, they'll take profits. That's expected. People don't know why it's moving up, so they don't do anything. I see the movement, and I'm ready for the second spike or the third spike. I saw a stock today go up 30%. I saw a stock today go up 15%. Let me tell you why I'm smiling, okay? When I was on Wall Street 20 years ago, and stocks used to move, if my stock moved 0.5% in one day, I would do the math. I'd be like, 5 days like today would be great. It'll go up 2.5% on the week. That's awesome because people only look to make 10, 12% per year. So you're a new trader and you're like, I'm gonna double my money. I'm gonna make $5,000 real quick. I'm gonna make 10,000. You can do it. You can definitely do it, but there are rules in place to limit your risk, which I'm all about limiting my risk. So that's why I pick, back to my stocks, that's why I pick stocks that come around the bottom, stocks that are distressed, stocks that do an offering. An offering is never good. An offering means they're offering extra shares or warrants or some way to dilute their company, to make their company worth less. You know, they have a number of shares, say they have 100,000 shares outstanding and they're offering 10,000 more shares. Just to simplify it, they're adding 10%. So everybody looks at a stock price and earnings per share. So if you were getting $1 per share, say you had a blue chip type company like an IBM or an Apple, and you were getting a Facebook, you were getting $23 per share every quarter. That's what the earnings were, okay? Instead, because there's dilution, not that Facebook did an offering, or they're not going to because they have all the money in the world, but the offering, the stock price would go down by at least the offering dilution. So 10%, that means if the stock was at $330, it would go back to $300. And sometimes, if there's no demand for the offering, the stock could go even lower. I've seen companies, they do an offering at $20 and people go, well, it's not going under $20. I'm gonna buy at $20 because I know better. So I'm gonna get it at $20. I see it's at $19. I know it's going back to $20 probably tomorrow. These people are so stupid. There's an offering. These people are buying shares at $20. Why wouldn't I buy my share at $19? I'm smarter than everybody. Guess what? The offering is just, that's what they're selling the shares for. The stock could go down even lower, and then companies can actually go, we had to reconsider the offering, and now we're gonna change it. Instead of doing it at $20, we're gonna do it at $15. Now, you bought into your position at $18 or $19 thinking it's gotta go above 20. Well, you're wrong. So hopefully you followed my 25% rule and you only put in 25% for your first position, which would allow you to average down. But what I would tell you is if you hear dilution coming from one of your stocks, sell. When I hear dilution, I wait for the offering to close or come real close to closing. I figure out the offering price, where the stock's at, how far I think it's gonna go up. So these are all things that I think about. I talk about entry point being most important, okay? It doesn't matter what trade you enter into. If you're doing options, stocks, what have you, we always wait for the dip. There's a dip every day. Your entry point needs to be special. Unless you're just gifted and you know as soon as you buy a stock, it's gonna go up. Whether you buy it at $10, oh, it's gonna be $10.20, in 5 minutes. Well, yeah, if you know that, then that's okay, but that's never true. So instead of buying a stock at 10 or whatever dollars it is, Wait, plan ahead. I speak about planning ahead on my platform. It's a lesson, but plan ahead. Anticipate the dip of a few percent, 5% or something to that extent. So if the stock goes down and you're at work because you're not a day trader and you're just trying to improve your life or improve the life of your family or make extra money so you can have groceries or you could do whatever you want to do, go on a vacation, buy a new car. I don't care. I get it. You're investing for one reason or another. I'm just trying to teach you how to invest right. So entry point is most important. If you nail the entry point and you follow the 25% rule and the 10% rule, you're gonna lower your average cost if you're wrong about the entry point. And if you're correct about the entry point, you're gonna see your position go green right away. And if you're wrong, it'll be red to green, but it happens a lot quicker. Okay, 90% of traders, day traders, lose money. And if you're trading on a daily basis, even if you have a second job or you have a real job and you say you're not really a trader, you are. If you're watching the market, you're a day trader. So do you want to be one of those 90% that lose money, or do you want to learn, educate yourself? You're playing with real money. I don't care if it's $100, $1,000, or $100,000. You still should be smart about every decision you make. And that's why I choose stocks a certain way. I look for stocks that have been bullied. I look for stocks that do offerings. I look for stocks that may be fake news or like a Hindenburg report or Citron used to do short reports. I look for these kind of stocks. I do my own investigations. If I think that these reports were just for them, the bad guys, to make profit off you guys, the retail traders, 30 million of you out there, then I'll jump on the stock because I know it's gonna bottom, I know it's gonna turn around, I know I have my rules to help me average down and to be a safe trader, to leave emotion at the door. I don't really wanna stare at the screen or my phone or the computer all day and watch my stocks. I wanna know that this is where I'm gonna enter, I would be comfortable with it. I teach a lesson about comfortability. So you enter into a price, you're not checking your phone to see, did it go down? Was it a good price? Could I have done better? There are specific times that I suggest we enter into stocks. There's a specific way we enter into stocks. We always look for the best value, and we always have a strategy and an exit point. So if you like what you're hearing, please watch my other videos. Learn a little more. I'm not asking you to subscribe to my platform, which you can do if you want at 349trading.com. It's $3.49 a week. I'm trying to make it available to the masses. I want to simplify everything I'm seeing. I'm here for two reasons. One, to keep it simple. I'll simplify volume and demand so anybody can see. My daughter, who's 8, can tell little red bars, little green bars, and which she sees more of. And then I show her the pattern of the stock. I'll look at a 5-day chart and I'll say, which way do you think the stock is going? And she'll go, Daddy, you could see it's a U or it's a W. I see the W, Daddy. I go, yeah, it's probably a W. And if she sees an M, I'm like, you know what? You're probably right. It'll probably look like an M. It's probably going down. Daddy's gonna stay away. And she goes, Daddy, you love to talk stocks. You're always talking stocks. Yes, I'm always talking stocks on Twitter, on Instagram, on Facebook. You guys are my family. I'm here for a reason. I'm here to teach. I'm here to help you guys learn. If you're getting value from my videos, please click on that subscribe button, click on the notification button, get notified when my videos come out. Be the first to see them. Thanks so much. Appreciate you watching.